नमस्ते दोस्तों, आपका गोल्ड प्राइस टुडे न्यूज में स्वागत है। और आज हमारे साथ बहुत ही खास मेहमान मौजूद हैं। ये हैं पीएनबी पारिबा फोर्टिस के चीफ स्ट्रेटेजी ऑफिसर। और इन्होंने एक बुक लिखी है, द न्यू वर्ल्ड इकोनॉमी इन 5 ट्रेंड्स, इन्वेस्टिंग इन टाइम्स ऑफ सुपर इन्फ्लेशन, हाइपर इनोवेशन एंड क्लाइमेट ट्रांजिशन। सो इस किताब में इन्होंने कहा है कि सोने का भाव $4,000 के पार भी जा सकता है। तो उसके पीछे इन्होंने क्या रीजन दिए हैं उसकी चर्चा करेंगे, चांदी के ऊपर इनकी राय लेंगे। Today we are diving into the discussion about gold, silver and investment strategies with Mr. Philip, the Chief Strategy Officer, BNP Paribas Fortis, and author of the book The New World Economy in 5 Trends, Investing in Time of Superinflation, Hyper Innovation and Climate Transition. Welcome, Philip, and congratulations on the success of your book.
Thank you very much. Thanks for having me.
Yeah, let's start with the gold. In your book, The New World Economy in 5 Trends, you mentioned gold 115 times. What makes gold such a key focus for you, and what are your long-term views on it?
I'm a bit of a gold bug, and of course, in the complicated world that we have, we describe it in the book, and the many topics: the multi-globalization, the aging, the inflation, the debt. Unfortunately, also the many wars and conflicts there are in the world. It's a very good moment to hold gold. And we have a target of 4,000. And when we wrote the book, let's say 5-6 months ago, we were at 1,700 for gold. Today we're at 2,600, and we have a target of 4,000. So back then people said you're absolutely crazy. Now, as we are getting certainly in that direction, they're not laughing anymore. And the main reason is, so there are two main reasons. First of all, if you go to a new world order, we had a unilateral world that centered around the United States. Now you have China, you have Russia, of course, with the military power. You have a country like your country, India, which is really growing and becoming more powerful. You have countries like Mexico and so on. So it's no longer a world that's centered around the United States. And because the United States, of course, has weaponized the dollar, in the conflict when Russia invaded Ukraine. A lot of central banks around the world are saying we have to diversify away from US treasuries. And if they diversify away from US treasuries, well, they buy gold. So a lot of central banks around the world have been big buyers of gold. That's one element. Another element is, of course, the inflationary picture. When you go to a world that's highly inflationary, people will want to hold gold. And up until recently, we have seen, and we can see that from ETFs, investors have been sellers of gold because interest rates and real interest rates have gone up. But now central banks around the world are cutting interest rates again. So that means that also investors get on board. Investors were selling, central banks were buying, the price went up. Now central banks are buying, but investors will start to buy as well. So I think this will be a double whammy, and this will drive the gold price way higher. So I have a 4,000 target, and also something for the viewers. You always say gold price can double, and they say you're crazy. But after the fall of Bretton Woods, the gold price was $35 an ounce. Then it went to 70, 140, 280. 560, above 1,000, and above 2,000. So it already doubled 6 times. Why could it not double 7 times?
By when? $4,000?
Well, that's difficult. You know that when you give a target, you don't give a date, and the other way around. But it will not take 5 years. I think we will be there in a couple of years, but 1.5 years maybe. I think 3,000. The end of this year is certainly possible, and that is only 33% from that level. And okay, I mentioned 4,000 in the book, but that's not really my final target. I think eventually we could go way beyond that as well.
So, Philip, you expressed a bullish outlook on silver as well. What makes you so optimistic about the silver's future?
Well, I think silver is a little bit the cheapest commodity on the planet, because if you go back, way back to silver, and we go back to the 70s, to the Hun brothers, when they cornered the silver market, well, silver was at 50. Then it went down for a very long time. let's say 10 years or so ago, we reached also once again, or a little bit longer, 50, and now we're still at 32 and a half. So silver typically follows gold, but it has lagged it very badly. If you look at the gold silver ratio, it's extremely in favor of gold and not in favor of silver. So I think silver has the opportunity to catch up. And of course, gold is a precious metal. Silver is also more or less a precious metal, but while gold is like almost 100% investments, silver is only about 50% investments, and all the rest is, of course, in batteries, in solar panels, and so on. So there's a huge industrial demand, and the huge industrial demand will already be enough to eat away quite a bit of that. So technically, and then we talk about technical levels, the 32 and a half level, and we're sitting right at that level, almost right at that level at the moment, is very important. And I think if we take that out, we could say see 50, and then if 50 falls, well, yeah, then you're at all-time highs. So I'm a big bull on gold. I've written a lot about it in the book, but I'm probably even more optimistic about silver because I think that has a massive, massive upward potential. And of course, also the miners, because if you talk about the miners in gold and in silver, but also in other commodities like copper and so on, they have badly lacked the metal price. So I think there is quite some catch up to do as well.
So, do you believe we are currently in a commodities super cycle? What are your thoughts on the broader commodities market?
Yeah, absolutely. And then you ask me all questions about things I love, because I like silver, I like gold, I like commodities in general, and especially the battery metals, because you will have a massive demand coming in from the alternative energy, from the energy transition that's going to happen. And I strongly believe that we will move from a world of big oil and big gas to a world of what we call big shovel. If you move from a world from oil and gas to a world that's more electricity driven, well, you need a lot of these metals. You will need lithium, you will need cobalt, you will need magnesium, you will need copper, and quite a bit of the other ones as well. Now, I'm probably the most bullish on copper in this cycle because the other ones, I do not know what the batteries of the future will look like. So if all of a sudden you were to replace lithium by sodium, for example, well, we need a lot less lithium. If the new batteries will hold more nickel and less cobalt, well, you are less positive on cobalt. Silver, by the way, and we talked about silver a second ago, silver will be a big part of the solid state batteries. So the new batteries, there will also be silver. So that makes the story on silver even more compelling. But from all these battery metals, and I'm bullish on all of them, and in the book, we mention a long-term demand chart where you have the demand for all these metals from 2025 onwards to 2050. Well, that's a wall of demand that's coming. The composition of that wall is not so clear because you do not know exactly which metals you're going to use. But copper, I'm very bullish, and that's the demand side. But if you look at the supply side, we all know that we need at least 200 new copper mines just to fulfill the demand that's coming, and we don't have them. And if you know that a copper mine typically takes 15 to 16 years to put in production, even if we start building copper mines like crazy today, it will still take a very long time before we get the first ounce of copper. So I think this is a no-brainer. And the reason why commodity prices were a bit under pressure, of course, the last couple of months was because the world economy was fairly slow. This Indian economy is doing fantastically well, but the rest of the world is a little bit more complicated. China is also very complicated. China is, of course, also a big source of demand for. But okay, these central banks are cutting, the Chinese economy is stimulating, so demand will come from there as well. And then, of course, you live there, India, you're going to build over the next 20 to 25 years a lot of infrastructure, you will use a lot of copper. If you start to use more copper in a country that has a population like your country, well, that will be a turbo on the entire story. So yeah, I can only say that I'm absolutely bullish on these materials, and this could really be the biggest bull market we've ever seen in commodities. So I'm very excited about this.
So, my next question is about India. What are your thoughts on India and in the new world order? So, in 2050, how do you see India?
Well, we are very positive on India, and as we speak, we just took a position on the Indian stock market in our portfolios in Belgium. So, like I described at the beginning, you used to have a world that was unipolar around the United States. The United States were really the police force in the entire world. That happened after the Second World War and after the Cold War. But now, of course, you have countries like China, like Russia, that's taking positions. And then, of course, you have countries like in India, which I think will be very strong, will benefit very strongly from this new world order, because I think India, and it's very dangerous to talk about a country that you know and your viewers know way better than I do, of course. But from where we sit, that's always interesting to know what the outside sees you. I think is a country that's extremely well positioned, and a young population is doing the investment. Stock market is doing fantastically well, and I think there is still a lot of opportunity in the agricultural sector to gain productivity gains. And also, like I said, in the infrastructure, if you start to build out your infrastructure more, it will be fantastic. Other countries that will probably do well is in Vietnam, is in Mexico. And that's something entirely new. When I started out in this business about 30 years ago, we would look at countries. In Europe, we would say we're going to overweight Germany and underweight France, to give an example. And then the global cycle started to harmonize a little bit. And then you started to look at sectors. And then, of course, you start to look at teams. But I believe in the new complicated new world order that we have, that we will start to look at countries again. And we used to talk about emerging markets, and China was part of the emerging markets, even it's not really an emerging market anymore, but it's very high or very big in the MSCI emerging market index. But now we are not looking anymore. We cannot say anymore, I think we should overweight or underweight emerging markets. You should look at each country individually. How is the population? How is the demographics? How is the positioning? How is the positioning in commodities? How is the industrial policy and so on? And then I think that India scores very well in this new world order.
Yeah. So in your book, The New World Economy in Five Trends, you discussed about the inflation and interest rates. And surprisingly, Fed has already cut 0.5% rates in US Federal Reserve. So how do you see future outlook of interest rates?
Yeah, so in the short run, it's clear that the central banks will continue to cut. So typically when you embark on a rate cutting cycle, like we've seen in Europe, in the US, many other countries around the world, typically it's not 25 or 50 basis points. Typically you cut a number of times for about 200 in total or even more. But one of the main theses of our book, and then that's very important, and that's really the key point of the book, and also why we like gold and then commodities and other stuff, is that we will be living, I believe, in a world which is way more inflationary and will have much higher interest rates in the future. And all the chapters are an explanation for that. When your population ages, typically your inflation goes up. When you go to what we call a multipolar world with conflict, where people have to spend a lot on weapons again, well, that's inflationary. If you have to put in a lot of money for your defense budgets again, well, that's inflationary. So all these things tend to be inflationary. Commodity prices that were very low and not too volatile for many, many years will go higher, will be more volatile. So in our way, and that's our way of thinking here, is the world that we will have for the next 20, 30 years will look way more than the world in the 60s and the 70s of last century than in the last 30 years. And for people, that's very difficult to grasp, because we try to extrapolate the near past into the future, and sometimes you have to look way more back into the past. And also, if you look, for example, at all the political situations, India is once again fairly stable on a political point of view, but in Europe, all the extremist parties from the left and the right are winning. In the United States, we will have the Kamala Harris, Donald Trump election. So you will have way more volatility in government as well. The extremes win. And our book is in a way also a book about books, because if you start reading, I think we mentioned 100 to 150 books. And one book I particularly like in it is The Fourth Turning by Neil Howe. And The Fourth Turning, it's not a book to read under the Christmas tree. It's not a book to read at the beach. It's a book to read probably in the autumn when you're a little bit depressed, because it's not a very optimistic book. But the world that's described in this Fourth Turning is clearly a world of conflict within countries and a conflict between countries, unfortunately. Luckily, there's a first turning after the fourth, so we have to go to a difficult period. But after that, it will be better, and it will be the young wizards or kids that will probably help us out there. But that's the world we're going to have. And if you read that book, you say, yeah, we will have bigger government. We will have governments that interfere with everything. So that's all highly inflationary. And that's a huge opportunity here, because investors can take investments that, like gold or like equities or like real estate, that protect you from these inflationary waves that are going to come. But for companies as well, because if the cycle drives down interest rates and the cycle drives down inflation and even drives down commodity prices in the short run, but you believe, like I do, that in the longer term they will be way higher, we've been telling clients for a long time now, hedge your inflation exposure, hedge your interest rates exposure, and hedge your commodities. I can totally understand that all companies, and in your country it will be no different, everybody is hiring people to do AI, because everybody knows we absolutely do not want to miss that train. But if I were a producer and I used commodities or metals in my production process, I would hire some people who know the commodity market, because I think a lot of the very nice, interesting things will happen there in the next couple of years.
So, what are your views on is the US facing a debt crisis?
Yeah, probably you could say that, but that's maybe a little bit harsh on the United States, because there are many countries in the world that have the same problem. For example, the debt in the United States is easily going to 130% of GDP, but in Japan we're at 250 for years now. In Europe, there are also many countries with the same problem. And of course, if you look at the US, that's the biggest pile of debt that we have ever seen. It's 35,000 billion. That's quite a bit. They pay interest rates have gone up. Before they did not pay too much interest on that, but now you pay 1,000 billion in interest. That's more than the defense budget. If Trump's get to power, which is possible, certainly it will increase by 7,000 billion or something like that. So it's going to go up like crazy. And when you have a debt pile like that, you can do three things. You can say, like a good family, okay, we're going to tighten our belt. We're trying to make more money. We're going to grow a little bit more, and we pay it off. But in a world of a fourth turning, that's not going to happen. A second possibility is, okay, we're going to default. And watch out with a Donald Trump. He already defaulted on quite a bit of companies in his time. So he could say, I am going to default on the US debt. Good luck with the world economy then. So let's hope that's not going to happen, because default is very much disruptive for the financial system. And a third way, and you already know where I'm going, the third way is try to inflate your way out of it. So if you can let inflation run at 3-4% instead of the target of 2%, and you do that for 10 years in a row, you eat away half of the debt in real terms. Unfortunately, you also eat away half of the savings of the people, because the cash will be worthless. And that's the main idea. In a world like that, yeah, we could face a debt crisis, because if all of a sudden the rest of the world is no longer willing to take on the US debt, they have an issue. But they can also let it run, let inflation run, and then, of course, all the money in your pocket and our pockets will be worth way less, and therefore you have to own gold, silver, commodities, real estate, companies, wine, pigeons, old timers, all things that are tangible. You have to own them. And of course, if you can manage it, you should never exaggerate. But what we say to clients as well, own some debt, buy some real estate, and put some nice loans against it, because governments and central banks can do a lot of stuff, but they cannot inflate their debt away without inflating our debt away. And that means that if you have debt at a reasonably low interest rate, which you can lock in today because interest rates are low, you will be very happy in 10 years to come, because then the debt will be inflated away and your piece of real estate you hold will be worth still a lot. So yeah, it's possible, a debt crisis, but I think it will be more like an inflationary wave. Unfortunately, there are ways to protect ourselves from that wave.
So, what are your advice to investor?
Well, like I said, in the company side, if you believe what we were talking about, and you believe indeed that the cycle drives down interest rates, inflation, commodities, and we believe they will be way higher in the future, you should take the opportunity to hedge. As an investor, you should take a good hard look at your portfolio. And we all need some cash as a reserve. Your roof can fall in, so you have to fix your roof, or you have expenses for your children or whatever. So you always have some nest egg in cash that you need to weather unforeseen circumstances. But cash is not a good option, so we should move towards real assets. And then I think we are very used to buying bonds and equities. Well, I think we should complement that with strategies like trend following in commodities. I think we should complement that with gold, with silver, some miners, some real estate, and all the other things I've mentioned. So I think there's a good opportunity here, and a story that I always tell to clients to make this visual. A metaphor is a game of Monopoly. And in a game of Monopoly, some people have certainly played that when they were young, or with their kids, or with their grandkids. There are two scenarios possible. If somebody holds, for whatever reason, sometimes dumb luck, the expensive streets, well, the game is fairly quickly over. The guy who holds those streets wins. But we've also lived through the situation where it's evenly divided. So it's very difficult. It continues, but each time you pass through start, you get more money. And we've all been in a situation that all the money of the bank is in the hands of the players. And then it's already 1 a.m. You still have another drink. You don't want to stop. And what you start to do is you start to make little papers, and you start to write on it $2,000 and $5,000. So you start printing money. But that does not solve the problem, because the pile of money keeps getting bigger. And the main conclusion of this, and there's also a conclusion that we draw in the book, is in Monopoly and in life and investments, it's not so important how much money there is on the table, but at the end of the day, who owns the streets, the hotels, and the houses. And I can add to that the companies, the factories, the wine, the gold, and all the real assets, because that's money is only a means of exchange. It's been a store of value, but above all, a means of exchange. And if we add some zeros to that, it's still money. But the house is still the house, company is still the company, and the kilogram of gold is still the kilogram of gold. So that's what we need to hold, and that's something I tell at the end of every presentation with my clients to make it visible. And you can see from my enthusiasm, I strongly believe in that story.
Yeah. Thank you so much, Philip. Friends, this book is now available on Amazon India. Thank you so much, Philip.
Thank you for having me and for your time.